Hello everyone, and welcome to my channel. Today, we are starting a new video series dedicated to the world of finance. If you're new to this field or looking to deepen your financial knowledge, you're in the right place. Before we dive into the details, it's important to understand some fundamental concepts. Finance is a broad field that involves the acquisition, management, and investment of money. Let's start with the basics. When we talk about finance, we often come across terms like stocks, bonds, mutual funds, and more. But what do they mean? Stocks represent ownership shares in a company. By purchasing stocks, you become a small piece of that company and share in its profits and losses. Bonds, on the other hand, are loans that you or a company might make to a government or a corporation. In return, you receive interest on your investment. Mutual funds are a popular way to invest. They consist of a group of individuals pooling their money together to purchase a diversified portfolio of stocks, bonds, and other financial instruments. Stocks represent ownership shares in a company. When you purchase stocks, you are essentially buying a small portion of that company. As a shareholder, you have a stake in the company's success and, in turn, you share in its profits and losses. This means that if the company performs well and generates profits, you may receive dividends or see an increase in the value of your stocks. Conversely, if the company faces financial difficulties, the value of its stocks may decrease. Investing in stocks allows you to participate in the growth and performance of the company you have invested in. On the other hand, bonds are financial instruments that represent loans made by individuals or companies to a government or corporation. When you invest in bonds, you are essentially lending money to the issuer for a specific period of time. In return for your loan, the issuer promises to pay you periodic interest payments, typically semi-annually or annually, throughout the life of the bond. At the end of the bond's term, known as maturity, the issuer repays the full amount of the loan, also known as the principal, to the bondholder. Bonds are considered relatively less risky investments compared to stocks, as they offer a fixed income stream and are backed by the issuer's ability to repay the debt. The interest rate on bonds, also known as the coupon rate, is typically determined at the time of issuance and remains fixed. Investing in bonds can provide a stable income stream and is often used to preserve capital or generate regular returns. Mutual funds are widely popular investment vehicles. They involve pooling together money from a group of individuals with similar investment goals. The pooled money is then used to create a diversified portfolio of various assets, such as stocks, bonds, and other financial instruments. By investing in a mutual fund, you become a shareholder of the fund itself rather than directly owning the underlying securities. Professional fund managers are responsible for selecting and managing the investments within the fund, aiming to maximize returns and manage risks on behalf of the investors. One of the key advantages of mutual funds is their ability to offer diversification. The fund's portfolio typically consists of a wide range of securities across different sectors, industries, and asset classes. This diversification helps to spread risk and reduce the impact of any single investment's performance on the overall fund. Mutual funds also provide access to investment opportunities that may be otherwise challenging for individual investors to access due to higher capital requirements or specialized knowledge. Moreover, mutual funds offer liquidity, allowing investors to buy or sell their shares on any business day at the fund's net asset value. It's important to note that mutual funds come in different types, such as equity funds, bond funds, index funds, and more, each with its own investment objective and risk profile. Before investing, it's essential to carefully consider the fund's prospectus, which provides details about the fund's strategy, fees, and historical performance. Investing in mutual funds can be an effective way to achieve diversification and benefit from professional management, making them a popular choice for both novice and experienced investors. Now that we're familiar with some basic concepts, let's see why financial management is so important. Good financial management will help you plan for the future and achieve your financial goals. You'll learn how to save, invest, and make informed financial decisions. From managing household budgets to investing for the future, personal finance is about building a solid financial foundation for yourself and your family. Throughout this video series, we will also explore investment strategies, financial analysis, risk management, and much more. It will be an exciting and informative journey. If you're ready to gain new financial skills and explore the world of finance, don't forget to subscribe to the channel and turn on notifications so you won't miss the upcoming videos.